Good morning, good afternoon, good evening to all of Clipper Nation. Thank you so much for joining us on Friday, August 25th for a presentation between Mark and Michael on the daily rebalancing portfolio of Clipper and why it is the best place to park capital. Before I bring them up to the stage, I'm going to do some quick announcements. As you know, this is one of the final events of week one of the adventure where we learned about the sail token. A number of the ships took a number of quizzes and quests and had tasks to do. And you're welcome to ask your captains. I encourage everyone to finish all the quests via QuestN, and you can access that via your adventure inventory screen treasure chest. Next week, on Monday, we'll have a score wrap-up of how everyone did for the first week of adventure. And the people at the top of the leaderboard are going to have an advantage going into the second week of the adventure, which begins on Tuesday, and we'll begin with a presentation on governance. So we have a lot of fun things coming up. Presentations galore, lots of tasks, lots of learning to do. But today, we're going to learn about Clipper's rebalancing portfolio and why Clipper is the best place to park your capital. We'll have time at the end for questions, which can be on this topic or anything that your little mind wants to hear about, and we'll give time to anyone who needs to ask questions. But for now, let me bring Mark and Michael to the stage. Thank you so much for sharing your knowledge with us. I am sharing my screen. If you have links for me to share to the audience, let me have them. Otherwise, take it away. Thanks a lot.
Sure. Hello, everyone. I don't have any links. I think the blog posts do a pretty good job of sort of laying everything out. So if anyone wants to read more about this, I would highly encourage just reading those blog posts after my talk. But yeah, so I guess I'll start with what exactly a rebalancing portfolio is. If you're not familiar, this is a pretty kind of like classic concept in traditional financial markets. Basically, the idea is that you have a target allocation for where your assets would be. So for instance, in like a traditional portfolio, you'd have a target allocation of bonds versus stocks, and within your stocks, you'd have target allocations for different sectors or even individual stocks. And you would try to rebalance your portfolio over time as prices change. For instance, if you have a target allocation of 50-50 bonds versus stocks and the stock market goes up a lot, then you would want to sell out of your stock position to an extent and buy some bonds. And the main benefit of doing this is that you can have, you target a risk mix which you're comfortable with, and then you are kind of set on this risk mix no matter what happens to the market. Because if you just sort of buy your starting assets and then just hold them, then you can be in a position where if prices change, then suddenly you have a different risk mix than you wanted to sign up for. So in the initial scenario I gave, if stocks go up a lot, then all of a sudden most of your money is in stocks, and you are potentially more exposed to the vicissitudes of the stock market than you would be comfortable with. So naturally, this is a concept that people have wanted to apply to crypto. And at first glance, it might seem that something like Uniswap is replicating this, right? Because what do? Well, you have 50-50 of each asset in the pool, and you deposit it, and the way that the constant product formula works is that your liquidity position is always made up of 50-50 of each asset, right? As the price goes up and of your asset, of one of the assets, let's say it's denominated in USD, your position will be less of that asset and more of the other asset. So when you withdraw, you will still have 50-50 of total value in each asset. Now, the problem is that in this kind of classic Uniswap market maker, you don't get the benefits that rebalancing has in traditional markets. In traditional markets, rebalancing outperforms the market under a lot of. But with Uniswap, you are exposed to impermanent loss, and you end up worse off than if you had just held the assets in the first place. Even though your risk profile is being adjusted, you are losing money from impermanent loss. And this is because things like Uniswap are always behind the market to an extent. In that, let's say, it's a ETH USD pool, right? And the price of ETH goes up on centralized exchanges. So there's going to be demand for ETH from the pool because the price is out of balance, right? Like ETH is worth more than the pool is pricing it. So people are going to go hit the pool and try to buy more ETH. And the Uniswap market maker doesn't know ahead of time that the price has gone up, right? It is sort of operating with outdated information because it prices solely based off of the assets in the pool and the demand in terms of trades that have come in. So what you can do to try to mitigate this is to incorporate off-chain oracles or on-chain oracles. On-chain oracles are always going to be slower, and Clipper uses off-chain oracles. And so Clipper has a target allocation, but adjusts its prices using off-chain oracles. So in the ETH USD case I just explained, what would happen with Clipper is that while there would be more demand for ETH, right? And Clipper would notice that, oh, okay, we have this target allocation, and since the ETH price has gone up, now we're actually have more ETH than we want in terms of our target allocation. So we would actually be looking to move out of ETH in that situation. So our prices would reflect the current state of the market, and we would look to rebalance by offloading ETH according to the prices on centralized exchanges. And by doing this, Clipper is essentially acting as a constantly updating portfolio, right? That is using the most up-to-date market information as opposed to fully on-chain protocols which are operating with outdated information. And so that's mostly where the benefit of Clipper in terms of replicating a rebalancing portfolio comes from. Another nice thing is that in traditional markets, rebalancing portfolios generally rely on active management on the part of the managers of the portfolio to actually make the trades that bring the portfolio back into balance. And Clipper is operating as a liquidity provider, so people are actually making the trades for the pool that will bring it back into balance. The pool is simply quoting trades that will bring it back into balance at a good price, and people make those trades for the pool. So you are not incurring the costs of making trades in terms of fees or the price of, in the traditional market, the best corollary to fees would probably be the price for actually paying a manager to make the trades and manage the pool. So that's basically how Clipper does this. And again, Clipper is essentially always rebalancing. It's with every trade, it is rebalancing to what it believes the target allocation should be. Whereas in a traditional rebalancing portfolio, this rebalancing has to occur sometimes, every quarter, sometimes up to every day, but generally it's, unless you're with a very large and well-managed portfolio, it is not always feasible to rebalance every day. So yeah, I mean, that's the short of it. Mark, I don't know if you want me to expand on anything in particular, or if you want to speak now.
Well, I have a bunch of questions because I think this is a really interesting topic, and some of the things you're mentioning are just, intuitively, some are intuitively obvious and some are intuitively strange. So the first thing, which I think is really interesting to call out, is that none of this requires fees, right? It's just by keeping your portfolio in balance, what you're saying is when things go up, you're essentially selling high and buying low and selling high, right? And so the result is that what you're saying is this the value of the portfolio increases without actually having to charge anyone fees. Is that right?
It depends on some constraints, like assuming like general kind of like volatility and not sort of unidirectional market movement. Yes, that's true.
Right. And so let's talk about the regimes under which this might outperform or underperform just holding assets and not rebalancing your portfolio.
Yeah. So generally, it outperforms when there's volatility. If there's unidirectional movement, then hodling will tend to outperform. But in a volatile market where prices are going up and down, and the daily rebalancing portfolio will outperform because it's sort of selling high and buying low at multiple points as the price goes up and down. So if volatility is high enough and there are enough movements up and down, then the rebalancing portfolio will outperform. If there's just if the price is just going up, up, up with no pullbacks and low bidirectional volatility, then the rebalancing portfolio will be inferior, although by not that much. But if there's volatility, the rebalancing portfolio will outperform, and the rebalancing portfolio is also much less risky.
Okay, so what I'm hearing is basically if the market's moving but it's volatile along the way as it's moving, then the rebalancing portfolio essentially does very well relative to just holding assets.
Risk adjusted, yes.
Risk adjusted, right? So let's talk about this idea of risk adjusted, right? Because that's an interesting concept. Can you tell us more about like risk adjusted and portfolios and how you think about even comparing the risk?
Sure. So, I mean, risk adjusted basically means that you kind of apply a fudge factor to the returns to account for the riskiness of certain strategies. And so some strategies, maybe they outperform in certain regimes, but they would also heavily underperform in other regimes. So when you say something is risk adjusted superior, what you mean is that when you account for all the possible different market movements and the degree to what exactly you are risk adjusting for depends on what kinds of market movements you consider possible, which is why adjusting for risk has been problematic throughout financial history because it depends on what you define as possible. But yeah, it just means that the returns are superior whenever you account for the possible downsides of similar market movements in the opposite direction.
It makes it a tough thing to compare. I mean, in DeFi, we often look at APYs, right? And or we look at hodling. And so it's really tough to compare risk adjusted to non-risk adjusted portfolios because it incorporates all these things that could have been. How do you think about evaluating performance? And maybe you can talk about benchmarking a little bit as you do.
I mean, I generally think about evaluating performance and in comparing to USD value. That's generally what I prefer to do as opposed to accounting in crypto value, especially in the current regime we're in where we're not in some kind of just like insane bull market where everyone wants to denominate everything in crypto. I think it makes the most sense to benchmark according to USD, and in the current regime, especially the risk-free rate becomes a more important benchmark because for a while we were operating in a regime where U.S. Treasuries were giving out pretty pitiful returns. Now they're not, and it makes more sense to benchmark according to what you can get just by buying U.S. Treasuries.
Okay, got it. So let's look at what Ben has on the screen now. So, this is the Clipper daily rebalancing portfolio, right? And it's got 60% volatile assets, that's ETH and BTC in particular, and 40% stables. And let's scroll down just a bit to see how Clipper tracks to the benchmark. So basically, just to read this and make sure it's clear to everyone, the purple line is the theoretical daily rebalancing portfolio, right? And the white line is Clipper's actual performance relative to that, right? And so, what this shows is like, in your optimal ideal portfolio, here's what your returns would be and how Clipper compares to that. How do we think about translating that into APYs in the way people think about it in degen terms?
I mean, that's a difficult question. I would say that the thing is most pools are denominated in APY versus the initial input of assets. So apples to apples would probably be that. I mean, the problem is that oftentimes, especially recently, crypto assets are going down. So even if the APY is positive, your return is substantially negative. So again, I prefer to think of things in terms of U.S. dollar returns, risk adjusted. So I would say that from that point of view, Clipper comes out ahead.
Makes sense. Great. Okay. Thank you. And, it sounds like, the reasons it comes out ahead is because there is volatility relative to, directional movement in markets. And so the portfolio basically, this benchmark makes money from this volatility. But it also sounds like there's other places where people could make yield, right, on their assets. Maybe it's U.S. Treasuries. Maybe it's staking ETH. Would it be fair to say that which is better depends on how much volatility there is in the market?
Yeah, I mean, the thing is, like in large part, it depends on what happens to ETH, right, or what happens to crypto in general. So it's not just volatility per se; it's also overall market movements, which is hard to predict. You can make a better estimation of volatility, but in large part, the what's better depends on what happens to the crypto market. But those things are you're taking a much bigger risk by essentially betting on a movement one way or another. So Clipper allows you to be a little more neutral.
I see. And so, and on a risk, put another way, on a risk-adjusted basis, it still has the benefits of diversification and so can be superior.
Yeah.
Interesting. Well, this is all very complex. There's a lot of different things to think about. And I guess that's why robo-advisors exist, because they tend to handle all this for you.
For sure. Yeah. And again, a lot of this, there's difference of opinions. These things are not even fully resolved one way or another in traditional finance. So, of course, they're not resolved in crypto.
Got it. Have you heard of the phrase the only free lunch in investing?
Yes, I have.
What does that mean to you?
I mean, it's what people use to describe the rebalancing portfolio. I mean, it makes sense, right? Like, it's free in that you're always going to outperform according to certain types of risk adjustment with a daily rebalancing portfolio. It's free in that, you are guaranteed to outperform on average. So if you don't have strong opinions one way or another about how the market is going to move, or if you are unwilling to make such a bet, and it is free lunch.
It's free lunch.
I actually wonder if I could jump in there. So if we're talking about on average, you're going to outperform just holding an asset, and if you don't really, you said have an opinion one way or another how the market performs, that a rebalancing portfolio is the best place to park your capital. Like what type of person is drawn to that strategy? Mark or Michael could answer that question.
I think this would be a better question for Mark.
Well, I think the type of person historically that's attracted to that strategy is one that I think works with a financial advisor or takes a medium to long-term view of the market, and they just know it's going to go up long-term. They have faith because that's very well researched and very, pretty easy to predict that stocks go up over time, and crypto has gone up over time similarly. And you want to have an optimal risk-adjusted portfolio to benefit from that. You don't want to get wrecked, and you don't necessarily have time to spend, every day, trying to optimize every potential thing. Or maybe you don't trust yourself to, right? Like if you're trying to time the market, it's kind of like trying to do a rebalancing portfolio, but like not following the rules in doing so, right? Like when ETH is high, you think it's high, you sell. And when you think ETH is low, you buy back and forth from USD. That's rebalancing your portfolio, right? The thing is, historically, people are really bad at timing the markets. And maybe if you're like a professional hedge fund manager and you do this all day long, maybe you can do it. But even then, the data doesn't show that people are very good at it.
Yeah, I was going to say, even like...
Oh, I think we lost Michael.
Yeah, I'll see if I can. If he raises his hand, I'll see if I can bring him back up on stage. I don't know where he went.
Great. Well, what I think he was going to say is, even hedge funds and mutual fund managers, they don't outperform the markets, right?
Right.
They're notoriously bad at timing. And so the way I think about it is it's almost good to force yourself to have this discipline, right? Like it seems like almost everyone who, just wants to put their money in the markets should really do it on a rebalancing portfolio. It's the best risk-adjusted way to do it. It has the only free lunch in investing where you're kind of getting, a better risk for similar return. And, it does it for you. It's like a rigorous strategy. And so to me, it's kind of like the place to park your capital if you want exposure to a sector. And I think that's why places like Betterment and Wealthfront, this is exactly what they offer. I think looks like we have Michael in the audience again.
Yeah, I invited him to speak.
It's why I think a lot of financial advisors suggest this to their clients, and it's why I think the risk departments at a lot of banks basically require the net position of all their traders to be, for the whole bank to be in roughly some sort of, portfolio like this. And kind of is like a no-brainer. Now, I'm not saying this isn't financial advice, right? But we are discussing how financials tend to work. And I think that, kind of implies that like most people should use a portfolio like this. And honestly, like most people do in the traditional markets.
Yeah, it takes the emotion out. If you have the base level research and the faith in the market, then you don't need to be in there every single day buying high and selling low, or I guess that's how the bad traders do it. So it kind of the rebalancing does it all for you, and it works off the volatility. Whereas volatility kind of wrecks human emotion, volatility is good for rebalancing.
Right.
I wonder, Mark, it almost seems like a natural breaking point with Michael being kicked off the stage. You're welcome to join at any point. But I wonder if we give time to the audience to ask questions, And while we wait for their questions, I actually have one. I want to give you the opportunity to explain to the audience and also to me about this new proposal. I'm going to put it up on the screen. So if you stick around and come, as you know, when Sail token was launched, Sail is going to be used as is currently being used as the governance token for Clipper and Admiral DAO. And we have a 5-phase approach for how you can propose things to make it happen within Clipper. And come Tuesday to find out how to participate in that process. But we do have some early learners and high achievers that have made some proposals. One of them is Captain T, who's a captain for Bloodsail Bandit. And so in the his proposal's already made it to phase 2. It got posted this morning. But he proposed a staking program for distribution of Clipper revenues. And I have it up on stage. I don't know if you want to read through the proposal, but maybe you could. I mean, it's Captain T's proposal, but you guys are there are some financial wizards in here. Captain T can maybe come up as well. But Mark, would you be willing to talk a little bit about the staking program for distribution of Clipper revenues, what it means, and why it might be good for LPs within Clipper?
Sure. And I see Michael is in the audience and has his hand raised, so maybe we can fuss around and bring him up.
Yeah, I've given him the invitation to speak. I'll see if he accepts it. We'll see how it goes. Thanks.
No problem. So yeah, this is a good question. So Clipper generates revenue, right? So here's how it does that, or protocol fees, put another way. So the benchmark of the daily rebalancing portfolio, which we've spoken about, during this call, it kind of it naturally generates returns for LPs who are in the pool. And you can think about this as, APYs if you want. If you translate these, they range from, 5% to 70% some weeks, if you want to compare apples to apples with other pools like Uniswap, depending on how much impermanent loss they have in a given week and how much volatility there is in a given week. But Clipper also, and so that's where LPs get their yield, just from the portfolio itself. In addition, Clipper adds a spread, call it 10 bips or something. So prices are a little higher, a little lower when it does this rebalancing. And that means that, the more volume that goes through the pool, the more fees accrue to this spread. And these can go to the DAO, right? Why can they go to the DAO? Because the benchmark itself is already a very attractive place for LPs to park their capital. It just generates yields. It's the only free lunch, right? Like we've talked about. And so this spread is kind of excess returns above the benchmark. And so that can go to the DAO. Now, what does the DAO do with that? Well, one thing it can do is put it in protocol on liquidity, right? So the protocol controls more and more of its own liquidity. But the DAO can decide to do whatever it wants with it. And what this proposal is saying, and I think it's an interesting idea, is maybe that should be distributed to people who participate in governance. So there's a lot of ways to do this, right? It's compensation for participating in governance. The way Sushi does it is you stake Sushi and you get X Sushi, and then protocol fees are distributed to all the holders of X Sushi. Curve does this with VE economics. So if you lock up your Curve for longer, you get more VE Curve, and that's more voting power. And to compensate you for that, voting and that commitment to vote, you get a portion of Curve's protocol fees. And GMX does something similar. And so these are really interesting ideas. Ultimately, things like this, it has to be up to the community to decide. But it's a very exciting proposal, and I think it's really worth discussing and voting on. And so I encourage you to vote on it now. And I think it also will answer a lot of the questions that people have about Sail and why they should participate in this DAO. Ultimately, it's good when everyone participates in the DAO, and participates in making judgments about the protocol, because that leads the protocol to be more successful. And so it makes sense that the protocol should compensate people for that work. And that's what this proposal seems to be about. And I think it's a really cool idea to consider and vote on.
Thanks, Mark. So we encourage all SAIL token holders to participate in governance process. The governance begins in Discord. You have to earn your SAIL token holder role, which you earn by having SAIL and then getting the role through the integrated guild.xyz bot, which will allow you to see all the governance channels and vote. And again, there's a session on Tuesday to learn about all the process, the 5 phases of governance that a proposal will go through before the DAO will adopt it. We do have some comments and questions in chat. Risky Jambalaya says, if I understood clearly, Clipper rebalancing is time basis rather than threshold basis. Is there anyone that'd be able to speak to that? And Michael, welcome back to the stage.
I'll let Michael reply if he can, and so he can also mic check that he's back.
Yeah.
But if he can't, I'm happy to answer.
Yeah. Well, Michael, if you're there, go on. Here we go. Perfect.
I'm having a few technical difficulties here. I don't know if you guys can hear me.
Well, we can hear you. Welcome back. Do you need me to repeat the question? Oh, well, I'll give you a shot. So Risky Jambalaya asks, if I understood clearly, Clipper rebalancing is a time basis. Got it. We can hear you. Go ahead.
Yeah, I heard that. I think it's probably better for Mark to answer just because I seem to be having some difficulties keeping the mic going here, but give me another minute or two. Maybe I can answer the next question.
No worries,
No
Mark.
problem.
It's on you.
So Clipper, if I understand that correctly, does Clipper rebalance at a given frequency, like every day or every month, or does it rebalance whenever the pool gets out of balance? The answer is, I think the answer to your question is threshold basis. I think that's the best way to answer the question. So let me explain. So in portfolios you see in TradFi that are rebalancing portfolios, they'll rebalance like once a quarter, right? And they do it based on time. Why do they do that? Because it can cost some money, like in transaction fees, to do the rebalancing process. You have to pay for the trades, and it takes a lot of effort and whatnot. And so they can only take advantage of this free lunch in investing, in portfolio management, once every quarter because there's some costs. In Clipper's case, every trade that someone makes with Clipper rebalances the portfolio. So it's continuously rebalancing, right? Every block it's rebalancing, because really the faster you rebalance, the better. And so Clipper, the benchmark is kind of the daily rebalancing portfolio once per day, and that's time basis, right? It's once per day. That's the benchmark that it tracks against. But Clipper is actually doing it continuously. And that's another place where excess returns can come in. That's part of the reason why Clipper can actually do better than the benchmark. So why can it do it so frequently, right? Anytime the price moves out of balance, it's because the pool doesn't have to pay transaction fees. The traders are basically paying those transactions for LPs, but they're getting the benefit of trading. So they pay the gas, they pay, the transaction fees, and the pool gets the benefit of that and rebalances constantly, continuously. And that's a really valuable thing, right? So put another way, what prices does Clipper quote? It quotes the prices necessary to keep the pool in balance. That's how it decides what prices to quote. And then the traders make those trades and continuously rebalance for the pool. That's how you get to do free rebalancing. And that makes it threshold based, because anytime there's a change, it implies there's going to be, a price quoted a certain way to bring it back into balance. Like maybe you need to sell a little more ETH than USD, and so the price is a little bit lean towards ETH. But the benchmark itself is a time-based one. I hope that answers the question.
Yeah, and if I might close the loop just to maybe understand it a little better by way of comparison, the more traditional dexes that don't have this rebalancing portfolio, is it correct to say that the way that they come back into balance, those pools, is via arbitrage? As in, the pool doesn't know what the target balance should be, it doesn't know the price of ETH. And so if ETH goes up and people are trying to, the balance of the pool doesn't reflect that, so the arbitragers will bring it back into balance, which hurts LP. Whereas these daily rebalancing portfolios, Clipper's daily rebalancing portfolio, it has a target, so it adjusts the price every quote, which means, is it fair to say the pool is, it's less, it can't be taken advantage of in that same way?
That's right. So if you rebalance at market prices, this rebalancing portfolio makes, generally appreciates. If you rebalance at bad prices, then it's not going to appreciate, right? The rebalancing process matters. And what happens in dexes like Uniswap, right, is in order to rebalance, like they can't incorporate the market price to decide what price to offer to traders. They require arbitrageurs to come in and make trades at the old price until the pool gets back into balance. And so if you're doing trades at old prices instead of current prices, you lose all the benefits of rebalancing. And that is a shame. And that's where impermanent loss really comes from, and why Clipper doesn't have that impermanent loss.
Thanks so much, Mark. So that's great, and we're actually coming up on time. So, and I don't see other questions. So, I just want to end. You guys are welcome to stay on stage, but
maybe I'll say one
give
more
you
thing,
final
which
words.
is you asked about personas who can benefit from this. I think everyone can. It's a place to just park your capital and let the markets, it's an optimal portfolio management on a risk-adjusted basis, and the portfolio kind of does the work for you. In addition, there's a lot of other people and profiles that in particular need something like this. One example is like DAO treasuries. If you're part of a DAO and that DAO has a bunch of USD and ETH and BTC, which a lot of DAOs do, how do you manage it? It's really complex to try to rebalance it and decide how to, what APIs are. Like, probably the right way to deal with that is just do a rebalancing portfolio, right? That is a responsible, conservative, risk-adjusted way to manage a treasury. And so I think there's a lot of entities like that out there that also should be considering a rebalancing portfolio. And so for those in the audience, if you're part of a DAO, you should probably point them to Clipper, because it's a great way to responsibly manage a treasury.
Yeah,
whether it's a DAO treasury or your personal treasury.
Let me hop in on that for a moment. I don't know if I'm muted, actually. Okay, good, I'm not. Because some people in the community have already taken that initiative and gone forward and proposed to 1inch that Clipper should be a treasury management product. And everyone here can go vote for that. It's in our best interest for this to pass, because 1inch will park a bunch of their capital in Clipper pools. And I was actually planning on turning the discussion to the adventure, because we've kept this very real life. And there are a bunch of people in the audience that are part of the adventure and having fun with it. So an adventure activity, when we go into governance week next week and in later weeks, we would love it if, as evangelists for Clipper, that our pirates go out and suggest and use what they've learned in our governance to suggest to other DAO protocols that they should be using Clipper as treasury management. And the reason that I jumped in it the first time is when we were talking about impermanent loss that most of these dexes do. I'm just going to put up a picture. For the adventure, the Black Scourge is impermanent loss, and that is the main villain during this adventure Clipper sales. So as we go through the weeks of the adventure, we're going to be battling and defeating the Black Scourge. And here's it looks pretty scary, but we have the tools, which is the community, the daily rebalancing portfolio, and the governance of sale token. So I kind of hopped in and stepped on your final words, Mark, but back to you. I just wanted to do a quick plug for the adventure before we ended.
I think that's great. I mean, impermanent loss really is a scourge. It's hurting everyone in DeFi. And if we don't solve that, it's going to destroy DeFi because LPs will go away. And so together, like, we really need to defeat impermanent loss. And Clipper provides a way to do it. And together, I think we can convey that across the DeFi ecosystem, and help DeFi flourish as a result.
That's beautiful, Mark. Thanks so much. So everyone, join us on Monday for a recap of the adventure scores. On Tuesday for a governance presentation. If you're part of the adventure, there's activities and tasks and quests to do all throughout. You can always ask your captains for help. I'm going to stop recording. I'm going to say goodbye to Mark and Michael, and then we're going to do a giveaway when the recording's over because YouTube can't handle it. So on behalf of Mark, on behalf of Michael, I'm Floss2X Daily, head of community for Clipper Dex. Thank you so much for joining us today, and have a great weekend. Bye-bye.